many of us thought interest rates would be going down sometime in the beginning of this year, or even last year when we thought there was going to be, I can't believe it, over 5 rate cuts. And obviously we didn't have as many, having President Trump win. Then we thought it was going to be interesting for the environment for this year. Then with tariffs coming up. So, it almost seems like it got pushed to 2026 and not in 2025. But we have an expert, and I know his time is short today because he has another meeting jump on, but we do want to share something so important to commercial real estate is the finance. And with the finance, very different from residential. A lot of people hear capital markets, but Mitch, if you don't mind coming and maybe explaining a little to everyone else, the finance, the debt size, there's always the middle piece, and then there's the equity. But I think a lot of times many agents or residential, even some commercial, they're just good salespeople, but they don't understand the finance and how important it is in commercial real estate. If you don't mind, maybe a little quick intro and then sharing what capital markets is and what finance is, or the debt side.
Oh, absolutely. Well, thanks, Jim. So just real quickly, two seconds about me. I'm the CEO of ComLoan. We're a marketplace for commercial real estate lending. So we match borrowers with the perfect lenders. We probably have about 1,000 lenders that we have relationships with. So we have a pretty good overview of the market and where the market's at. And essentially, your capital stack on any commercial deal, obviously you've got your equity piece, and sometimes you could have pref equity or mezz financing in between that, and then obviously the bulk of it generally is debt. Most buyers will leverage in order to increase their returns, and obviously the lower the interest rate, the better that works because the less you're paying on interest. To Jim's point, I think everybody was expecting some pretty significant interest rate cuts this year, which I think they're going to come, but they're going to come towards the end of the year, maybe September, December. I think, as long as the markets continue the way they are, inflation's down around 2%, and the jobs numbers are looking great. So I think there's going to be a lot of pressure on the Fed to start reducing interest rates. But once again, I think it's going to be towards the latter part of the year. So in any commercial real estate transaction, the debt one of the most critical components, because that's how you get your numbers to work. At the end of the day, a commercial deal is all about the numbers and all about your return on investment. So how much money are you putting into it? What kind of a return are you going to get on an ongoing basis as far as the cash flow that's coming from the property? And then ultimately, the game is hopefully that values go up and there's a nice capital bump at the end as well. So I think that's just a very high level overview.
Yeah, and thank you, Mitch. One of the big things that we knew and we were talking about is a lot of the amount of the refinance, obviously with interest rates moving, the COVID affecting office buildings, right? The numbers didn't match up. Can you just share for a lot of people there, the basic underwriting, what underwriters are looking for, since you work with, thousands of banks? I mean, it is incredible. Can you just show basic underwritings to let people understand the different pieces that go into figuring out, should they give you the loan and how much should they give you?
Yeah, so I mean, at the end of the day, it's all, any lender really just wants their money back, and they want their return. They have very little interest in taking properties back. That's an absolute last resort. And I think any lender that has that kind of philosophy, you should run for the hills, because it's normally a private money lender that's probably unscrupulous. So I think at the end of the day, so you got really essentially two scenarios primarily. You've got stabilized properties, which are generally fully leased up and stable. And then you have properties that need some kind of rehab, and those aren't stable. So on the stabilized properties, underwriters are going to be looking at your tenant mix, your occupancy, what occupancy level is it at? and then obviously the cash flow from the property and ultimately the NOI, net operating income that's being generated by the property. And on stabilized, they normally have a ratio, what is called a debt coverage ratio, which is essentially the NOI's ability to cover the debt payment. And that ratio normally is in excess of 1, obviously. So they would normally want, say, a 1.25 or 1.3. So the net operating income generated from the property is going to cover the debt 1.25 or 1.3 times. And that's generally the rule of thumb on stabilized. And then it's really also going to be very dependent on the asset type. So multifamily, you got generally shorter term leases, 1 year, 2 years maybe. So they really don't look at the tenant mix then, because it's just, people living in the apartments. So those are generally going to be looking at occupancy levels, and then normally they'll calculate some kind of a vacancy factor, and then in order to come up with the correct NOI. And they normally look at generally the last 12 months. You can get away with the last 6 months, and in some cases, the last 3 months, if it's recently stabilized or something, recently the property's been rehabbed. So that's generally on multifamily. When you start getting into other property types like, industrial or retail or office, then the tenant mix comes into play as well. They look at the strength of the tenants, how strong is the tenant, how long is the lease. Generally, most lenders want the majority of leases on those type of properties to be at or in excess of the term of the loan. So, for example, if you're at a 5-year, if you're looking for a 5-year fixed loan, you don't want all your leases maturing in 3 years, because the lender could potentially be stuck with no tenants at the end of 3 years. So generally, they're going to want the leases to run. They're going to want to look at the strength of the tenants. So, so for example, there's been a lot of Walgreens closings recently. And so if Walgreens, and that's normally a single tenant, right? It's just one building that's normally owned by an investor, and then it's occupied by Walgreens. And there's concerns if there's a lot of word out there about a lot of closures, et cetera, et cetera. The underwriter is going to take a serious look at their properties. Is Walgreens going to be closing that particular property as well? So I think at the end of the day, they underwrite on stabilized properties, once again, just the property's ability to support the debt. On a rehab or non-stabilized property, so somebody buys a apartment complex that, say, for example, needs to be rehabbed and then leased up, the underwriters essentially are going to look at the performance and say, what are they projecting once this property is fully renovated, and then they'll look at the area. What are the occupancies in the area? As far as the projected rents, are those in line with what that area can support? So they're really going to try and look at how strong are those pro formas and projections. Are they realistic? And then generally, obviously the property can't support the debt because it's empty, or it's partially empty but it's a totally different underwriting process, and generally the interest rate's higher. So on a rehab type property, you're going to probably have about a 2 to 3, maybe even higher % bump on the rate than you would on a stabilized property. But that's underwritten based on the pro formas and what it appears that the property will support once it's stabilized.
Mitch, there's just so much variables. People have to look at product type, area, and you and I even know sometimes banks' appetite, if they do too much concentration in an area, they just stop lending, right? They just say no more. So it is with Calm Loans having a variety. And if, Mitch, you don't mind putting your contact information, because I use the tech. A lot of times when I was at Marcus, I had to run debt quotes. Sometimes the commercial mortgage broker doesn't want to work on your deal, too small, too busy. But I love with Calm Loans, I always say it double checks everyone, where they research and you run quotes. Granted, their numbers, they don't tell you the actual banks unless you sign an agreement, but it does keep everyone, I would say, honest on the different ratios that everyone needs to look at. And, I remember you told me that one of the best is using community banks. So can you tell me right now, what are the most deals that are done right now, and what are the ones that have the most hair on it that's kind of hard to push through? So what is everyone trying to push through right now that's getting approved, and what takes a little work and they have to run around finding really the middle piece or some more equity or some other structure?
Yeah, so I think you said it earlier. It's going to be very dependent on property type and area. So for example, office, is one of the property types that's having the most issues at the moment. But the ones that are the most affected are these large office towers in the inner cities, in the big cities, Chicago, New York, LA. Those have by far the highest vacancy rates. But when you start going out into the suburbs and you have your smaller, um, more suburban office buildings, which maybe 2 story, 3 stories, smaller type, maybe in total maybe 20,000 square feet type unit buildings. Those generally are still we're still able to get financing on. Um, I think the other big thing that's going to affect office is AI. A huge percentage of the white collar workforce is going to disappear over the next 5 years. It's a given. A lot of positions are going to be replaced by AI. We're at ComLoan focusing a lot on AI as far as the underwriting of loans and predictive analytics and that kind of stuff. So it's very exciting for those of us that are embracing AI, because it ain't going away. And we have a saying that either you're going to ride the wave or you're going to get swept away by the wave. So I just encourage everybody to really open up your eyes to AI and see how it can help you and your business, because it's really going to give a huge edge to those that embrace it. Having said that, other property types that are really strong at the moment, retail is actually really strong, and we all thought that retail would fall off the face of the earth when with COVID, but it's really come back strong. So generally retail's good. Once again, if it's a larger retail store, they're going to look at the anchors and how strong are the anchors. Like, for example, if there's a Home Depot in there or a Kroger or whatever the case might be, those are obviously very, very big, strong companies, and those are great anchors. So retail's generally across the board's great. Industrial is still very, very strong. With the whole online market and all these online entities, like for example Amazon and industrial just is huge. Another big thing that's coming up are data centers. I think with AI and moving into the digital age, we actually getting quite a few loan requests for data centers, which is quite interesting, the shift. Hospitality is pretty good as well. Once again, very, very regional, very much based on the property. We're currently doing a large hotel just right on the grounds of the SoFi Stadium. So it's a larger hotel, more expensive hotel, but just the location's outstanding. It's really overlooking the SoFi on the grounds. So I think once again, location is critical with any property and any property type. The strength of the sponsor is also critical. If you got a very, very strong sponsor, that overcomes a lot of challenges because they feel there's a lot of strength behind the deal. And you could overcome some of the other shortcomings on the deal with a very strong sponsor. Student housing, senior housing is still pretty good. And then obviously multifamily, which is sort of the staple. which seems to be chugging along. And I think the area where multifamily was affected in certain areas, and I know it's parts of the Southwest, where there was just an enormous amount of syndication. A lot of people got into it, and particularly when interest rates started going up, they bought properties that needed rehab. Their rehab, all their numbers were based on rates remaining where they were when they were done with their rehab and they needed permanent financing. And unfortunately, the rates didn't. So a lot of those properties, the short-term rehab loans are maturing, and they're facing much higher interest rates, and the deals aren't penciling out. They've got to come in with additional capital to do that. So that's where there's a little bit of headwinds on multifamily. But I think, that it's no secret there's just an enormous shortage of housing in this country still. And so I think multifamily is still a great investment, still a great opportunity. But once again, it just really depends on the deal, and the deal has to pencil, at the right prices. Unfortunately, I think also in the Southwest, prices, rose up at such a high rate, and the cap rates were at ridiculous numbers, 3%, 2.5%, 2%, and that's at low interest rates. And then all of a sudden now at the higher rates, the deals just don't make sense at those numbers. So I think there'll be a realignment on those deals. And I guess as the old saying is, in the stock market and in real estate, for every loser there's a winner, right? So it's the market will readjust, and but yeah, I think, once again, multifamily is always a good bet.
And Mitch, right now, what is the multifamily rate? Let's say a 5-year loan. Just what is the ballpark right
Yeah,
now?
so the multifamily, you essentially look at three different categories. You have your banks that are very active in multifamily, and generally that's in the early sixes, the early to mid sixes. You have agency, which is Fannie Mae and Freddie Mac, and that's broken into essentially two categories. You have the small balance, and then you have your regular. The small balance is really running similar to bank rates. Um, and then your regular is actually in the mid fives, the mid. So and that would be generally above $5 million loan amount. But so really ranging anywhere from the mid fives up to worst case probably the mid sixes, and that would be on a stabilized property. And that's generally maybe a 5-year fixed on the bank. Your agencies, you tend to get better rates the longer the term, maybe a 10-year fixed. Once again, the difference with commercial opposed to residential is there aren't any 30-year fixed rate loans. I mean, there's HUD, but if you want to wait a year to close the loan, I think our record is we did a HUD loan that took a year and a half to close. I'd totally forgotten about it when it closed. It was like, oh my God, what is this loan? Um, but yeah, there's this built-in refinance market constantly for commercial. You just there. It's generally short-term loans, anywhere from 3 to 10 years is typically on a stabilized property.
And Mitch, right now, because we've been talking about kicking the can down the road because rates haven't come down for a long time, right? Ever since I would say 2021, it just kept on going, going, going. 22 stayed there pretty high. Rates we thought would come down, didn't come down. Inflation got a little stickier, but there's all these different scenarios. But we all know a massive amount of loans are going to be coming due. What are you hearing now from everyone about the amount and maybe the solution, or is it just still trying to kick the can down the road where the banks don't want to acquire, like you said, they don't want to own property, they just want to get the interest, and the larger ones I know they don't take back, but the smaller ones they will. So what do you see that's going on now with the clients or the investors about holding on? Because it's been a long time.
Yeah, so I think the wherever possible, the lenders are, as you say, kicking the can down the road, hoping rates come down. Um, And what they're doing, they're just extending. So if a note comes due, they'll give them an extension for another year or another year. I think they're all very reluctant to want to take these properties back. I mean, they all lived through,
Yeah.
the RTC days and some of the other major downturns, '08. It's just generally not good business. You lose a lot more money. So they try and wherever possible keep their borrower running the property and involved. Um, but I think there's literally, and the area where I think there's going to be a lot of disruption is CMBS, which is the commercial mortgage-backed securities, and particularly on the large deals, these large office towers. There's no kicking the can down the road for those. I mean, at some point, they're going to have to swallow the pill and bite the bullet and just deal with the losses, and they're going to be massive. I mean, it's in the trillions as far as what's coming due over the next 2 years. It's like 1.4 trillion or something was the number I heard. It's a massive number across the board. So I think the smaller banks are going to try and work with people when you start getting to CMBS and agency, because those are securitized loans. I think there's less flexibility to actually work. I mean, because it's a security that's being put out there on the market, and there's really not that level of flexibility in extending. I think the big relief will come, and I got to believe, unless anything dramatically changes over the next several months, I do believe their rates will start softening as long as the market can continue behaving the way it's behaving with, I think with the tax cuts, that's going to be very stimulating to the markets. A lot of foreign investment will be stimulating. So I think generally business likes that, and as a result, I think there'll be a fair amount of economic activity, and as long as inflation stays low, the Fed will start reducing rates. I think it's a given. It's not going to happen, I think, maybe the earliest September.
Yeah, and Mitch, I know it's a short session. I just want to open it for questions before I ask some more questions. If anyone has it, please, raise your hand or put it in the chat. But it is important. This is such the important thing. I know, and compared to residential, they will say it's pre-approved. It's almost certainty. And in commercial, you got to go get a appraisal, which is very difficult. It's not as easy as residential, cookie cutter. All these ratios, and for a good agent, you got to be good at underwriting. A lot of us that have been through it, we could ballpark, right, and look at it with the income, the LTV, the leverage, area, product type, right, risk, margins. I mean, these are almost like good commercial agents are economists because you have to. And we look at stock market forward indicators, all these research reports, right, to indicate, to give our clients the best information. So it is important, if you're in this industry, not just to sell property, but to understand the underwriting, because you got to underwrite at the bank. Banks are usually the most conservative. So when you use their underwriting, it's good to know that is kind of the lowest, where I hate to say, right, Mitch, the brokers are overly optimistic. So when you get a package, you got to look at it yourself, take out the numbers, add the real numbers, say this is what it is. The worst thing is to think you got a deal, waste your time, and it really doesn't go anywhere. And I know a lot of people go through this exercise, or talk to people like you, Mitch, that are in the business, because there's always that middle solution, right? We always say, the debt is easy as long as you have the equity, right, to balance out the ratio, or if you could do some magic on the income expense, but a lot of times those are pretty fixed. A lot of times it's just, can you add more money? Can you add more equity? So Mitch, what are you seeing now for people trying to bridge the gap? Are there those solutions to bridge the middle piece if their loan is coming due and they have no solution?
Yeah, I think there's quite a few entities, funds that have formed to bring in mezz financing or pref equity. So they're coming in and taking an equity piece. I mean, does work out quite expensive. They obviously want a good return for doing that, but it saves the deal and it saves the property. So, I think that's the beauty of capitalism. There's always somebody that's stepping in to fill a gap in a market and looking for an opportunity. And I mean, I think that happens, if you look at lenders aren't consistent at all. Lenders are constantly coming in and out of the market depending on how much capital they have available, what exposure they have for a particular property type. So you could have a bank that's been crushing it on multifamily and all of a sudden they pull out of the market because they're just too exposed. And I think that's the advantage of working with a marketplace where as one lender pulls out, another lender is going to fill that gap. But to know who that lender is the challenge. And obviously, we've got the technology that really matches the borrower with the perfect lender. And ultimately, you can never say get the best because we don't have 100% of all the lenders on the platform of the country. But we have, I think there's $6 trillion worth of lending capability in the country or debt available, and we cover about 3 trillion of it. So we cover probably all geographic areas and all major property types, and that's the key, is really just having reliable debt on a deal, because it's such a huge component of the deal. And the last thing you want to do is take a deal all the way to the end and be in escrow for 90 days, and all of a sudden have the lender pull the plug at the 11th hour, which unfortunately does happen on commercial. Residential is very homogeneous. They run it through DU or LP, which is an automated underwriting engine, and as long as you can provide whatever it kicks out, because the key thing on commercial is you underwrite the property. On residential, you underwrite the borrower, which is a very huge distinction. Obviously, they'll look at the sponsor or the person behind the deal, but the emphasis is on the property's ability to support the debt, where on residential, you're actually underwriting the individual. So it's a very different process. So there's a lot more certainty on a residential deal up front to say, yeah, you've been pre-qualified, we've run the DULP, you're approved. But unfortunately, that's not the case on commercial.
And that's what we always say when we were calling, or residential agents called us, they say, we got a pre-approval from the residential lender, and they had no idea. And that just wastes a lot of time. But I would say this to save everyone time, use Calm Loans, at least run the debt quote, and you match it up with who you're working with now. Because also, Mitch, kind of a plug for Calm Loans. You guys kind of are doing a rating system. You don't let people do phishing, right? We can do it all, and then they don't do it all. So can you just share, because it is certainty of making sure you do have the financing. Otherwise, you don't close a deal and you waste in commercial months. So can you share about how you put people on your platform and the quality control?
Absolutely. So we have a lender service department. We've built up our database of lenders over 10 years. We actually have relationships with each and every one of the lenders on our platform. We understand exactly their parameters, what they do. They got to go into their system at least once every 90 days to update their lending parameters. The rates are kept current using algorithms. So the rates are current daily. And we do an analysis of the rate in the system opposed to what they quoted. And we're normally within 0.2% on average across the board. So the rates are very accurate. And so it's, I think there's some entities out there that call themselves marketplaces, and all they do is they scrape the internet for names and phone numbers. And, we've got 6,000 lenders that they built over a year. We built 1,000 over 10 years because we actually know who will lend on that property type in that geographic area in that particular lender. So, for example, a big bank like Bank of America probably has 6 different profiles in our system, the SBA, the CMBS, the middle market, the private bank, etc. And then within that, there's probably 6 different contacts within each silo, depending on geographic areas. So you get into the exact person for that exact loan type who will handle that particular property type. And I think that guarantees the certainty of execution, which is key.
Mitch, thank you. I know you got to
I've got a hard stop, and I apologize. It's one of those interesting days where it's like back to back to back, but it's good to be busy, right?
It is good to be busy. Mitch, thank you for sharing. Please look at Calm Loans because it does run debt quotes and helps you find other solutions, because not having more banks, we all say having more money, having more finance partners is the best. But Mitch, thank you so much for being on, and thank everyone for being on Top Agent Commercial Wednesdays. We will always have on the next one AI and a economic review. So we're going to have an economist speak. So be in touch next week for Top Agent Nation Commercial Wednesdays, where we will talk about AI. But Mitch, have a great day. Thank you so
Thanks,
much.
guys.